Yo, what's up, guys? Today's gonna be the first book that I'm going to put in this new style of videos that I talked about I'm gonna be making. Sorry about that. Alright, let's get started. So, in my last video, I said that I'm gonna be talking about books that I read and just basic highlights of what I think is the most important parts. First book, The Intelligent Investor by Benjamin Graham. This book is known as the Bible of investing by many, and Warren Buffett regards it as one of the best. I mean, it changed his life, which is not surprising because Warren Buffett was basically a student of Benjamin Graham in Columbia University, I believe. So basically, this is my third attempt at reading this book. Every time I come to this book, I get overwhelmed by how difficult it is to understand the concepts. But I can finally say in the third time I was able to get through it. I still didn't understand a heck lot of it, but enough for me to get a good understanding of what this book is about. So to start off, I would basically just to point out that this book is more of a philosophical way of thinking to be a great investor and not about exact techniques to use to beat the stock market or anything like that. That being said, I'll like to start off where I put my markings at. First page being number 72. So let's go there. All right. It's probably gonna be a pretty long video because I'm gonna have to find the part of the page which I wanted to read out, because I just marked the page. I didn't mark exactly which part of the page to read out to you guys because it's a library book. Anyways, I think I found it. Alright, so what Graham was doing at this part of the book was basically he was giving three scenarios of people who could be investing, right? So he had a widow, a woman whose husband died basically, and she has $5,000 to invest. Another is a doctor, which has an annual income, and lastly, a young man who saves about $500 a year, right? So I'm only going to read to you about the third one because it applies to me. Not that I only save $500 a year, but I'm a young man who doesn't save a lot of money. Anyway, so what he said is that for people who are not really into investing heavily and not investing in their education of being a great investor, which I'll mention in a while in the future in a moment, how to what extent he's talking about. Your best bet is to have some of his savings go automatically into Series E bonds. That's what he says, right? And he also puts down that the balance is so modest that it seems hardly worthwhile for him to undergo a tough educational and temperamental discipline in order to qualify as an aggressive investor. So first of all, if your cash flow is not high, then it does not even make sense for you to put a great deal of effort into studying to be an investor. You're much better off being more of a defensive investor. That's another thing. This is the two types of investors he goes back and forth within the book: the defensive, more conservative one, and the enterprising or the aggressive investor, All right. So the only thing to take out of this page right now is that Series E bonds, United States Series E bonds, okay? This will come up in further pages, so I'll not go too much into it right now. Page 75, right after. Okay. Very first sentence, I believe that's what it is. The enterprising investor should start from the same base as the defensive investor, namely a division of his funds between United States savings bonds and a high-grade common stocks bought at a reasonable price. The key point there is bought at a reasonable price. So to backtrack a bit, whether you believe that you are gonna go out there to beat the market, or you're just here to kind of understand, to have some basic rules, to have a slow, long-term, moderate income coming in, which most people should be doing anyways, not the other one, okay? Because majority of people are not going to be the aggressive investor. If they try to be, they're going to lose money, most probably. Anyways, the key that he puts out is high-grade common stocks bought at a reasonable price. And his brief definition of reasonable price is basically 2/3 of what its historical value is. So if a stock is right now at 100, you should be basically buying it under 75, around 70. Better around under 50, but that's like 50%. So around 75 is a good price according to him. Just a rule of thumb. There's much more that goes into it than that, right? Page 77, preferred stocks have. He just adds on the fact that preferred stocks have severe sinking spells, as he puts it, in bad market conditions. While most of them do that, they also have high recovery rate when market conditions tend to be better. But it's just a warning, and it's he points out, let me find his exact words. Two contradictory attributes which the intelligent investor must bear clearly in mind, okay? So basically, if you are somebody who's buying stocks, even at the reasonable price, you should bear in mind that this could pretty much at any point plummet down to maybe $10. You bought at 75, it goes to $10, $30, whatever the price is. But your point would be at looking at the market condition, not the price of the stock at that point. Because if it goes that low, as an investor, the people that he wrote this book to, those type of people shouldn't have to care that whether it went to $30 and $10. He just has to know that the market is in a bad time and I'm not going to let it go. If the stock goes to $10, you might as well hold it, even if it risks meaning the company's going to go bankrupt or whatever and you lose all your money, compared to selling it off at $10 and then later on in time it coming back up over 100 again, right? Page 90. I hope this is interesting. I might add like a little background to the back, a little background music, because it's a long video, but probably not, because I'm not really into editing videos. I'm too lazy for that shit. I'm just making this just to see how this sounds later. Get somebody to watch it. Anyways, page 90. For example, the history of Dow Jones Industrial Values. Oh, sweet. This is a good part. He says basically that if you're somebody who fantasizes like this, right? I told this part to a friend, so I know how to explain it pretty well. So I do this all the time. I see a stock that's at whatever, $100. I see what the price was at 2012. I always look at 2012 because it was a time when I came to New York and I started my whole, like researching things and studying by myself, whatnot. Anyways, I always see what the price it was, the lowest at 2012, and then the highest it hit within that, from that time to now. And I always calculate with the calculator. If I had bought, using my tuition money, all the shares I could at $25, and then now sold it off when it's about 100 plus, I would have made this much money. And I feel like, oh my God, I wish I knew. And then I go to another stock or whatever it comes up, I always do this calculation. And he basically shot me down here, because what he said that is, if you're somebody, and his example was the Dow Jones Industrial Average or something, that went to that was as low as 42 and it was as high as 300. If you're somebody who looks at that chart and goes like, if somebody bought it around that price, 42 to 40 to 50, and then sold it around 300 or 250 plus, you're just a fantasizer. Like, you're just a speculator. It's going to be very difficult for you to be a real investor, because it's really easy to keep fantasizing of what has already happened, because that's what the game is all about. You can't fantasize about what has already happened and try to take that emotional, like, porn, basically. To us, that's what it is. Like, oh my god, if I had done it, and try to apply it to the future, like and try to basically say that what stock is right now at that stage, which that this one was in the past, that I could invest in, and it'll be at that stage in a couple of years. That's just fantasizing. So you need to quit all that. And he recommends a series of simple methods that he uses to give a better understanding, but nothing too technical. One of them is the various formula timing, where he says that you buy the share at basically what I said before, 2/3 of the average price it has hit, and you sell off 10% of the share every 10% it goes up. So if the stock you bought it at, let's say 75, let's say Apple, you bought it at 75, it's at like 100 something now. When it goes 10% up from 75, you sell off 10% of the shares that you bought. When it goes 10% more up, you sell off 20% of the share. If it goes 10% more up, you sell off 30%. So basically, if it went up from 75, 30%, you should have sold off 30 plus 20 plus 10. 50% of your shares should have already been gone out. And the reason is pretty obvious, but to point it out, it's because the idea is to get some profit, then compared to trying to hold it and let it all go in one big profit, which usually never happens, and it just comes back down, right? As it fluctuates, all he's saying is that first buy it as a reasonable price, and even before that, do all your homework on the company and whatnot. Then buy it as a reasonable price, and then when it goes up, every time it fluctuates up, sell it off 10%. When it goes up 10%, sell off 10% of your shares. It's pretty interesting, but this again, it applies to the enterprising or aggressive investor, right? 105. All right, I like this part. What he says here is that, I'll read it out to you, the whole thing. The aggressive investor must have a considerable knowledge of security values. Enough, in fact, to warrant viewing his security operations as equivalent to a business enterprise. So basically what this means is that if you're going to buy stocks to a company, you must have enough knowledge of stocks and the company and everything, as if you could basically start a business on the products of the company, equivalent to that. This is the extent he means when he says, when he refers to an intelligent investor, an enterprising investor, an aggressive investor. He's talking about going beyond knowing what it says on the balance sheets. He wants the person to know the company in and out, equivalent to be able to start your own one of those companies and creating those products, equivalent to that knowledge. Okay, that's the first thing. Then he goes on to something that he words so freaking, like, it's so sexy the way he words this. There is no room in this philosophy for a middle ground or a series of graduations between the passive and aggressive status. Many, perhaps most investors seek to place themselves in such an intermediate category. In our opinion, that is a compromise, and that is likely to produce disappointment and achievement. Basically, what this means is that there's in this game of investing, there is no room for being like you're like intermediate, and then you're like semi high level, then high level. It's either you are high level or you're not a high level. Okay? As an investor, you cannot soundly become half a businessman, expecting thereby to achieve half the normal rate of business profits on your funds. It follows from our reasoning that the majority of security owners should elect the defensive classification. They just do not have the time or the determination or the mental equipment to embark upon investing as an aggressive investor. This alone, if you can embody it and understand it, should take you like away from all the losses that are yet to come. Because what he's saying is basically, if you're a businessman and you're doing things right and you have knowledge and going out there and doing everything you can, let's say you're an intermediate businessman, you are therefore likely to get an intermediate amount of profit in that niche of the business, whatever you're in. But as an investor, it just follows from a state of reasoning, trying to quote what he said, that if you're intermediate and you just went deep enough to understand more than the average people, but not close to high enough to be an aggressive investor, you're more likely to get disappointed with your results than achieve success, because it just does not follow in that pattern of making money. Okay? And he says that most people should just accept themselves as the defensive investor as soon as they can, because in the long term it's going to pay off compared to trying to be the aggressive investor and losing all their money. And lastly, what I said was they just do not have the time, determination, or mental equipment, which refers to the beginning of the book where he says that it is a lot to do with having some unusual human characteristics, because most people lose money due to reasons that are very human, and to be able to make money in this game almost requires you to be non-human. I would like to elaborate more on this fact, but I'm just going to leave it at that. It's just the way it goes. It's very difficult to sometimes let go of a stock that you're losing money in and keep the hope that it's going to rise when mathematically it's just not going to come back. Vice versa. Many other examples. Moving on. 111. Okay. I like this because this is, I think, one of the first times. This is the first time that he says spot on, like, this is what you should do. Because most of the book, he doesn't really tell anyone to do anything. He says, United States savings bonds are by far the most important security ever issued in this country, or anywhere else for that matter. That's, as I spoke about before, the Series E bonds, Series G bonds, F bonds, whatever it is bonds given by the United States security. And then he goes on to after later pages explaining a bit about how it works. And basically, I believe it points out that, okay, here we go. If you were to save $75 every month, it would equal to you saving $900 a year, right? So if you were to invest that $75 a month into United States Series E bond, basically, long story short from all these pages is that after 10 years, you have to hold it for 10 years. If you cut it before that, there's some penalties. But after 10 years, you're going to get an income of $300 a year, an annual income. So saving $75 a year, bam, 10 years hits. You forget about it, you automate it for all these years. 10 years hits, and suddenly you start getting $300 a year. And your principal that you saved for 10 years, $900 a year, is $900, right? But that turns into a 15% multiplication with, what was it? 15%, wait, 10,400, right? So your principal becomes 10,400 while you get an annual income of 300. And if you keep reinvesting that $75, it's going to keep increasing, right? It's just that after 10 years, there's no penalty of withdrawing the money. And he believes this is one of the best things a person, in the majority could do, because it's thinking in long terms, and yeah, basically that. He goes on to saying what's very interesting is that most fund managers, or things that people put their money in that give them a return, are not really out there being active managers. They're just diversifying your money and investing less than 10% into it in a very conservative way. And he says that the greatest, I'm not at that page right now, so I don't know what he exactly says, but basically he says the greatest benefit of putting your money into another fund manager, or like something like a Vanguard or something, is that for the majority of taking you away from the losses that would have occurred if you were to go out and pick stocks by yourselves. So it is not the income that you get at all. It's not the 10% yield you're getting that's the greatest importance. It's just the fact that by putting your money out there, you're not going out, the majority of the people are not going out to invest by themselves, is the greatest asset. Because if they didn't have funds like that to put the money in, they would have tried to invest by themselves, and the majority would have lost. Coming back to the Series E bonds, the next pages goes on to him basically pointing out objections. Basically, he says, like, what are the biggest objections to not put your money in a Series E bond, or United States bond, and then he counters that. Okay, so to point out a few, the Series E bonds do not yield an annual cash income. Basically, if somebody says that I don't want to put my money in a bond, Series E bond, because I don't get an annual cash from it, and he counters that by saying that if you were to save $100 or more a year, he says 145. Basically, what he says that even if you don't get an income from it at the current moment, if you could save $100 a month, right, and 75 is going there, you're still in this. You're still not needing cash right now. He just points out a very obvious moment, and he says it's very obvious. You're not needing cash right now. You just wanted to add to your life because of whatever reason. We're humans. I have that too. I'm like, I don't get an income right now, so this is not really good. I get an income after 10 years. But again, one of the biggest things to take out of this book is to think in terms of long term, right? Another objection is those cashing out in their bonds lose most of their interest. And he says a large portion of Series E bonds have been cashed in before maturity. The figure is running at some 40%, and all such owners realize a smaller interest rate than the 2.90%, which is compounded semi-annually and obtainable after 10 years. We doubt, however, any considerable fraction of true investors, he pauses with a dash, the people for whom this book is written, have found it necessary to cash their bonds. Basically saying that if you are trying to be a good investor and You can't hold a small amount of money going out for a significant amount of time, 5 years, 10 years. You're just not a true investor. It's just investing is just not for you. It is, the art is all about holding something for a while, at least when it comes to bonds. I'll leave it at that because I don't know how long this video is getting, and I have a shitload of pages. Wait, 1, 2, 3, 4, 5, 6. I have 6 more. I'll keep going. I don't mind this video being very long, and I believe these videos are going to end up being quite long. Anyways, number 132. Sorry, I'm weighing about the law as if it's bothering me, but I'm having fun here. All right, so management. Okay, it's a little technical. Not really though. Where is this? The chapter starts here. Factors affecting the capitalization rate. Okay, so I'm going to read you 4 factors that affect that. Capitalization rate is basically, in brief terms, getting your return on an investment, right? So if I buy a real estate, let's say a plot for $100,000, and for some reason this gives me $10,000 every month, right? So the capitalization rate is $10,000 divided by $100,000, and that is 10%. Capitalization rate is 10%. Okay, and he gives four laws or 4 basic rules to look at before buying into such investments. Okay. First of all, he says that general long-term prospects, and he's not big on what's coming in the future. And to be conservative, he's more into finding and about the price that it is at right now, and if he's gonna buy it at a bargain price or not. That's all he cares about. He doesn't know. He is not into speculating too much. Number 2 is management, and basically he says that if the company that you thinking about investing in, how's their management, and let me just read out. This will have shown itself already as a past record. It will show up again. Okay. It is fair to assume that an astoundingly successful company has unusually good management. This will have shown itself already in the past record. It will show up again in the estimates for the next 5 years, and once more in the previously discussed factor for long-term factors. So basically, look at the management. How is the company run? Who is it run by? What are their core values? These things matter. Next is financial strength and capital structure. Basically, it says that if you have 2 companies that you are thinking about which one to invest in, they both have the same earnings per share, but one has a surplus of cash and another has huge bank loans. These are things to consider, because even though it doesn't look like there's any effect when you look at their balance sheets or whatever you look at, in the future, these things generally make a big difference, because having huge bank loans is probably not as good as having a surplus of cash. It's more of a thing to just point at and factor to add into your list of things to look at before buying a stock, rather than anything else. Lastly, what I think is one of the biggest things that I'm going to use if I plan to buy a stock is dividend record. He says one of the most persuasive tests of high quality is an uninterrupted record of dividend payments going back over many years, including periods of depression. If the company has been paying dividends to its shareholders for years and decades, even when things in the stock market was down and whatnot, hey, they got their shit down. 37. The chapter name is Stock Selection for the Defensive Investor. probably my second favorite chapter. The defensive investor who follows our suggestions will purchase only United States government bonds plus a diversified list of leading common stocks. That's what I said before. 139. It's more of an attractive, interesting thing that I noted than a lesson. And this, he says that watching these charts basically came to a conclusion of something interesting. An indication that a conservative approach may carry with it the rejection of really attractive investment opportunities. Such a possible disadvantage is inherent in a role of the defensive investor, and he must accept it philosophically. Basically, he's just saying that there's no need to go too depth, but at times, if an investment just looks too good to be true, reject it. Even if it goes through all the rules that you have set, and it's a really, basically a stock you're very excited about because you really believe it's going to do really well, pass up on it. It is one more thing that it requires just to be robotic and kind of almost non-human to do, because we have passion. This would be like one of the things that I probably can't even do. If I really believe a stock is going to be, it's undervalued and goes all the things, and I did all the tests and it's going to boom soon, I'm probably gonna buy it. If I have the money, I'm gonna buy it that day. And according to him, if it looks too good to be true, or very attractive in his words, pass up on it. Could go further than that. Very, very easier said than done. 143. One of the biggest factors to stick with is the price you buy the stock at. Again, he keeps emphasizing this point that look at the price you are buying at. It has to be bargain, okay? It can't be, even if everything is good, it just needs to, you just need to buy it at a point where it fluctuates in its low tide. 247, we're getting to the end now. I skipped a bunch of pages here because it was just not in my interest. But so once again, he says about the conventional and unconventional ways. To complete our discussion of the margin of safety. Oh, this was an important chapter. I didn't really take much notes on this because I read this on the train, which I apologize for but it is I recommend anybody to read up on and understand Benjamin Graham's concept of margin of safety, because it is a fundamental way, like even Warren Buffett made his money. Anyways, to complete our discussion of the margin of safety principle, we must now make a further distinction between conventional and unconventional investments. Conventional, another word for defensive, investments are appropriate for the typical portfolio. Under this heading comes United States government issues and high-grade dividend-paying common stocks. This time he added dividend-paying. So if some of you know of Warren Buffett, you should know that he's very into investing in things that gives him an income right now as the thing value. He's not that big on buying something and holding it for a future value to rise and selling it off. He's very much into getting dividends and etc. So yeah, dividend being common stuff. We have sometimes added state and municipal bonds also included. Okay. Unconventional investments are those which are suitable only for the enterprising investor, again, the aggressive investor. They cover a wide range. The broadest category is the undervalued common stocks of secondary companies. Bam! That's where Warren Buffett comes from. He basically made a soldier out of this kid when he was in university. And this is exactly what he did. He bought Warren Buffett's greatest skill is to be able to value or understand the value of a company that is currently undervalued. Buys it, that shit goes the hell up, and bam. So besides these, there is often a wide choice of medium-grade corporate bonds and preferred bonds and blah blah blah. Point is, majority of us are just supposed to be defensive investors at best. Try to be a defensive investor for 10 years, I would say. And keep studying to be and consider yourself inside as an enterprising, aggressive investor, but have your real doings as a defensive investor until the day comes. And by the day comes, I don't mean that the next time you really believe in it. I mean that let's at least a decade go. If you're 20s, let a decade go. If you're 30s, let a decade go. Get involved in the world of investing and then decide if you're going to make some moves in the other side. If you do it correctly, you shouldn't really need to make much high risk, unless your goal is to make it into the high millions anyways. So that's that. Last page. I love this page. Conclusion. Have the courage of your knowledge and experience. You have formed a conclusion. If you have formed a conclusion from the facts, and if you know your judgment is sound, act on it, even though others may hesitate or differ. In brackets, he says, you are neither right or wrong because the crowd disagrees with you. You are just merely right your own way because your data and reasoning is right. Similarly, in the world of securities, courage becomes the supreme virtue after adequate knowledge and tested judgment are at hand. Let me emphasize, after adequate knowledge and tested judgment are at hand. Tested judgment is another way of saying experience. Fortunately, for the typical investor, it is by no means necessary for his success that he bring these qualities to bear upon his program, provided he limits his ambition to the capacity and confines his activities within the safe and narrow path of standard defensive investment. Lastly, this is my favorite sentence in the whole book. To achieve satisfactory investment results is easier than most realize. To achieve superior results is harder than it looks. I hope you guys enjoyed this video. There's going to be more coming. I highly, highly recommend you to get this book. It's a heavy read. It took me a while to understand. Many pages I had to read over again. A good book to read before this would be what is it called? The Little Book of Common Sense Investing. And I did it backwards. I was supposed to get that first, then get this. But then I did it the other way. That's going to be my next book. Anyways, guys, hope you got some valuable things out of this. Peace.